Greetings. Welcome to another CAA session of key concepts in taxation of income in Zimbabwe. My name is Rino Mapetere, and I am an executive head of the postgraduate programs at CAA. Today, I would like to take you specifically through tax treatment of capital allowances in our Income Tax Act in Zimbabwe. So our learning outcomes are, what are they? These capital allowances. Which tax heads are relevant? Are they relevant in VAT, in CGT, or in income tax? Would like to do a walkthrough on how to compute them and the key factors to consider. This recording is already assuming for the candidates that are doing the Chartered Accountants program that you've done a lot of work in the undergrad phase. And for practitioners, it's also assuming that you have basic understanding of how capital allowances work. But what we are doing here is to give insights of the things that you need to put together before you do any calculations. We would like to look at the tax planning issues to do with dual currency, which is something unique to Zimbabwe, as we use Zimbabwean dollars and United States dollars in a dual currency arrangement, and what are the tax implications, especially for computing the capital allowances. We would like to connect the capital allowances to the recoupment we discussed earlier in another video. So you can go to our channel and have a look at the video on recoupment. Capital gains tax, it definitely is affected. Your capital gains tax computation is affected by your capital allowances treatment in the income tax side of things. So let's move into what are capital allowances. The starting point is in your general deduction formula for you to get deductions. Capital expenditure is not allowable. This is through section 15.2a that says any expenditure or loss that has been incurred for the purpose of trade or in production of income, but not of a capital nature, is deductible. So now we do have expenditures and losses that are capital in nature, and section 15.2a says they are not deductible. However, section 15.2c, which does not necessarily fight the general deduction formula but complements and gives further guidance, says for specific capital expenditures, I will give an allowance in the form of capital allowances. So we are bringing in a specific provision that is section 15.2c that defines which assets can get a deduction via capital allowances and not the entire cost itself, which is capital in nature. So section 15.2c points to the fourth schedule where further details are then given. Here, the fourth schedule will go back and pick out the items or the classes of assets that have been pointed by section 15.2c and further defines them. For instance, section 15.2c says you will get capital allowances on an industrial building, on a commercial building, on a farmhouse. The fourth schedule then says, let us define what an industrial building is, what a farmhouse is, what fencing means. It goes further to then say these are the available allowances, types of allowances. It then also gives guidance on how to apply these types of allowances to the different classes of assets. It prescribes the rates. It guides how assets in a hire purchase arrangement are treated in terms of capital allowances. It gives guidance in terms of additions and alterations to assets. And it also shows how to treat limitation on certain assets. You have to limit the cost that will rank for capital allowances. So for students, this is very important, because what we have just done there is we've put together 3 or 4 key components. Number one, we've discussed that there's got to be a class of assets. Number two, there's got to be a type of capital allowance. Number three, we're saying we've got to, it's about permutations and combinations. We've got to mix them in the optimal way in terms of our tax planning objectives. And this is what a tax exam, an applied tax exam, is trying to look for. It's not really trying to get you to just apply a 25% rate on a cost and do the calculation, which is a simple mathematical operation, and that has been tested in your ordinary level and advanced levels. Here, we're trying to put together these 3 key components. The tax planning gives you the objectives and the context. The Section 15.2c gives you different classes of assets. The 4th schedule then says these are the different types of allowances available. And this is how you can mix them, the allowance and the class, and come up with the dollar amount in terms of the allowance. Since you have options in certain types of assets and in terms of types of allowances, your tax planning becomes the underlying guide as to which option you're going to choose. So let's look at classification of assets as the first one. They've been mentioned in Section 15.2c, but they are defined in the 4th schedule. So it's an elaboration in the 4th schedule. Here you have different types of assets: commercial buildings, farm improvements, fencing, industrial, and so on. And that is a Section 15.2c list. When you then move over to the 4th schedule, they then define, for example, industrial building. Here we will not define all of them. And in there it tells you a lot of characteristics of the industrial building, including it containing and being used mainly for the purpose of operating machinery worked by steam, electricity, water, or any other mechanical power. And then it discusses if there's buildings that are attached to it or to that building and suffering depreciation because of the operation that's happening in the main building that is housing this machinery. It lists so many other, which I've skipped here, characteristics that once as a candidate or as a practitioner you understand these, you will use all these characteristics to check in the case of a student, to check against the scenario that you have been given, and in the case of a practitioner, whatever asset you are about to try and check whether you can get capital allowances, you must first apply these principles and this definition of the industrial building and come up with a conclusion whether or not it is an industrial building. This is a crucial first step of classifying the asset under consideration into one of the classes that is defined first in Section 15.2c, but also in the 4th schedule. If you fail to take this necessary step as a student, this has catastrophic implications, because a wrong turn at this stage will mean downstream a wrong tax treatment, and you will not get the necessary marks. Having classified, one will then say, okay, so what types of capital allowances are available or availed by the fourth schedule? You have special initial allowance, and the fourth schedule will then talk about how it works and its characteristics. Wear and tear, the same, the fourth schedule will expand on that. Scrapping allowance, training and investment allowance. Those are your key allowances available. And so the fourth schedule should be studied by the candidate because they now need to get into the exam with a full appreciation of how each one of these four works. Let us pick one, which is the special initial allowance, and say the fourth schedule will say which assets are applicable. So it will scope certain assets out, like your commercial building. You cannot get special initial allowance on a commercial building. So this is repeated, whether it's wear and tear, scrapping allowance, it will tell you the applicable assets. Then it defines the rate. 25% special initial allowance, 25% accelerated wear and tear over 3 years. Cumulatively, 4 years at 25%. It tells you whether it's on a straight line or reducing balance method, and in this case, it's on a straight line basis. It tells you whether this type of allowance can be apportioned in a year of assessment, and with a special initial allowance, it will not be apportioned. It tells you how special initial allowance is treated with leased assets, and it also discusses that it can only be granted when the asset that is under consideration has been put to use. So this is repeated across all the other 4 types of capital allowances, and you'll then be able to say, these are my 4, this is when I use them, I can only use them on these assets, these are the rates, are they is it on a straight line or reducing balance basis, can I apportion, what happens when I'm leasing assets, and so on. As a candidate, therefore, it is very important for you to go through that material. Now, therefore, as I alluded to earlier on, your examination for the ICAS examination, CTA, ITC, what is very important and what the examiner is trying to test is your ability now to match the correct class of assets to the best available asset allowance given the tax planning objectives that will have been established. The default tax planning objective that you will have in your examination is to reduce the tax liability. So in other words, you would want to claim as many allowable deductions as possible. However, it's not the only objective. Sometimes you can have an objective where the taxpayer would like to take advantage of assessed losses that are about to expire, for example. In other words, they don't mind if the tax liability goes up with another asset of theirs, as they know they will offset it with assessed losses, especially if you're going to have some merger or some acquisition where one of the parties has an assessed loss and the other has a huge tax liability. So here I'm talking about tax planning, and another example in tax planning where we were talking about reducing your tax liability. For example, a motor vehicle is eligible to claim both SIA and wear and tear, but wear and tear is 10% on a reducing balance in your first year, whereas SIA will be 25%. So in order to increase our allowable deduction, will therefore go for SIA, since there is an option to choose, and this option, exercising this option, is the tax planning aspect. For students that are writing examinations, you score more marks if you are able to identify the class of the asset, you are able to identify the suitable allowance that will either increase or lower your tax depending on the tax planning objective, and if you can perform a computation of the tax allowance itself, what is the cost? Remember, the cost is affected by a lot of things, including the arm's length principle, where the asset has been disposed of or acquired from an associate, and the question of arm's length comes through. The rate is determined by your selection of the suitable allowances we've already discussed. The period can be important, as well as in some cases you have to apportion the allowance, and the combination of those things is the allowance, and your ability to bring these things together is what is being examined over and above doing the mathematical operation and calculation. Moving on, planning, as I have already alluded to, it's yes about the tax planning objective, higher or lower taxes, but there are also other specific issues around dual currency in Zimbabwe, where we are using the United States dollar and the Zim dollar, and therefore it is going to be very important to understand how capital allowances are affected, and largely it's about unredeemed balances on capital allowances. And here we are referring to a simple example would be a taxpayer buys, maybe imports an asset that is being used for the purpose of trade and ranks for capital allowances, but they imported in United States dollars. But due to inflation, and let's just say they imported for using United States dollars, however, the business is predominantly selling and earning income in Zimbabwean states dollars. What it means is you are expected, therefore, to match the attendant costs in Zimbabwean dollars. That can be a problem, given that now the inflation will result, maybe in 4 years' time, the Zimbabwean dollar cost that was there at the time of acquiring the asset will have been eroded, and therefore the base on which the capital allowances will be calculated will be eroded as well. And for that reason, our tax law has allowed the rebasing. In other words, we're tracking the United States dollar balances on unredeemed balances on capital allowances and converting every time we are doing an annual return or tax computation for each tax year on capital allowances. So that's good planning. Recoupment as well is going to be dependent on what capital allowances that we got. We've already done a video. You can look out for a video on recoupment as well. So determining what will happen to recoupment is always based on what has happened with capital allowances. So your planning in terms of which capital allowances am I taking, when am I expecting to dispose of the asset, is going to be crucial there. Capital gains tax, yes. Remember, that one is now looking for the gain on the capital cost, the total amount, which we said has been excluded from income tax computations. However, the capital gains tax will take cognizance of whatever has happened on that asset on the income tax side, and your recoupment becomes an issue. Remember, capital gains tax will only arise when the asset has been disposed of. So that's why we are now talking about recoupment. But I'm saying recoupment is what goes to capital gains tax, but recoupment is a function of what you will have done with the capital allowances. So capital allowances affect capital gains tax. Evasion and avoidance. So given what we've just discussed on capital allowances, a taxpayer may then be tempted to evade tax. How? By maybe trying to put an asset in the wrong category so that they get the more capital allowances. That is not avoidance, it's actually evasion. It is illegal to do so. You need to interpret correctly the classes of the assets. You also need to interpret correctly how and which allowance is applicable, and failure to do that is actually evasion and not avoidance. Avoidance could come when the asset is acquired from from an associate and the transaction is not at arm's length. But then again, avoidance, as you know, increases your tax risk because the anti-avoidance mechanisms are there to then try and reverse that, and sometimes with penalties and interest. Common pitfalls for students is hard coding an allowance to an asset. So you've studied and you've seen a motor vehicle treated in a certain manner, but you then forget that every time it is better to go through the asset classification, allowance, understanding, and then tax planning objective, and then come up with the right, the suitable response for that examination on that day. So context matters. The components of bringing up of computing the capital allowances matter, and students fall into the common pitfall of just hard coding, just saying, I've seen this, last time I studied a certain solution, this is how buildings were treated. There are other context issues like what is the asset being used for, what is the location. The location of a building can change it from being a commercial building to an industrial building. So for instance, growth points, there are issues around treatment of capital assets in an export processing zone. Tax planning, like I said, can change the solution because maybe in this case, you're trying to take advantage of expiring tax losses, given that assessed losses have a 6-year limit. So that will change the tax treatment, that context. So students fall into that trap where they are not really engaging with the scenario and the question for the day, and then looking at the context and then piecing together a correct solution. Technical proficiency, students sometimes just fail to simply do the operation of what is this straight line or is it reducing balance? Am I apportioning over the year or this is not apportionable? When do I commence calculating capital allowances, given that I cannot do it if the asset has not started to be used for purposes of trade? Thank you very much. This has been another long recording, but I hope it is useful for your examinations.